Good morning. How's everybody doing? We're going to get started here in just a second. Let's let everybody get into the room. Let's come in here first thing. Let's go to see what everybody's saying. Let's get some comments going in here. All right. So we're picking people up as the system brings them in. So it's good to see everybody. Nice to have you here. Welcome, welcome. And what we're going to do today is we're going to pick up right where we left off last night. So we had class last night down at the university, and we ran out of time, of course, as usual. I have more information to share than what we have time to teach. So we got to the section where we were talking about indicators. So I want to come in and I want to talk about the indicators, and we're going to jump right into it. I'm not here to waste your time, so let's get started. First thing of all, I just want to point out that we are using Track and Trade here today. This is the software platform I use. You're going to have to make some translations into whatever platform you use. So if you use different platforms than I do, most of these indicators, not all of them, but most of these indicators are going to be found on those other platforms. You're just going to figure out where to find them and whether the settings work kind of the same. All right, so let's get started. We're going to pop right over here real quick, and we're going to go right back to the slides that we were using yesterday. We'll just start off right here. It says, what good are indicators? So it takes a combination of tools, order strategies, indicators, and price patterns to create a winning trading system. I'm sure I'm here to share with you my trading strategies and systems, but it's up to you to make it or them your own. So if I trade you, I'm going to show you how I use these indicators. I'm going to show you my favorite indicators, but it's up to you to take those indicators and kind of work them into your own trading strategy. I'm going to show you my trading strategy, but you have to adapt to it. So don't be rigid, be flexible. Markets are dynamic. They're constantly changing. So too must you as a trader. You have to be able to be willing to be flexible because the markets are flexible. All right. So here's the first indicator that we talked about. Is one that I created back when I was working at the Chicago Board of Trade, and I didn't really, I didn't invent it. I was taught it at the Board of Trade. I just adapted it into our software and added some things to it. So this is a tool that was being used by a bunch of traders back in Chicago. It was very popular. It's called the red light, green light system at the time. And it's a mathematical model. And what it does, it turns the price bars red, yellow, and green. And then, of course, we added to it and created some additional hyperbolic sequencing into it. But it's a hyperbolic rolling Fibonacci sequence. Identifies Fibonacci neutral zones with breakouts. It filters, the filter allows for both accumulation model and swing trade models. So it's very dynamic. There's a lot of things you can do with it. You'll see that there's a lot of settings for it. It can be used for both entry and exit and used in combination with recurring price patterns. Now, we did talk about recurring price patterns in class, so I'm not going to go through that right now. I'm going to assume that most of you guys here are up on your recurring price patterns. So let's actually, you know what? Let me just to bring that back home real quick here. Where is that link? Right there. There's the reoccurring price patterns book. So if you guys want to take out your little phones, and let's see, I'm going to do it on my phone to make sure it's working. So click on that, or not, you don't click on it. You point your camera at it. You don't take a picture of it. You just point your camera at it, and it comes up with a little yellow link inside of your camera window. And you touch that link, and it should open that file. And it does. Okay, so it opens the file. It works. So that's a 200-page document. It's a supplement to the manual. So if you don't have the manual, go to landturner.com and search for it, or go over to pitnews.com and go to the store and you can download it. So there's two ways. Go to Landturner, go to Amazon.com, landturner.com, and that gets you the manual, the book. And then again, go to pitnews.com, go to the store, and you can download the manual if you want the digital version. Digital version is a lot less expensive than the paper version. But this one's free. It's the supplement to the book. So if you don't have the book, well, now you got the supplement at least. But I'd recommend you have the book too, because that's kind of the foundation, and then the supplement sits on top of it. All right, so I want you to have that. Now we're going to come down here, and we're going to get back into where we were. All right, so right here. So the first one we're going to talk about is the bulls and bears. So let's jump over to the software, and we're going to talk about the bulls and bears indicator. We can get to the software. Come on, man. All right, so here is the Track and Trade software, and the way you turn it on, let's turn it off first so you can see how to turn it on. So we'll turn it off, and this is what and let's turn off Fibonacci. So this is what most people look at when they look at a chart. This is AMD, and this is what AMD looks like to most traders. All right, let's turn off this one here too. Let's come down here and just have volume on. So we just start from the very beginning. So this is what most traders see in most trading platforms. If you go out to, all the free crappy ones that are out on the internet that are given away to you for free, then this is what you're going to see. And this is what people trade off of. And that's what it is. It is what it is. It's kind of ugly. It's hard to trade on that, right? Nobody wants to trade on a chart that looks like that. That's why we decorate them up with indicators. Indicators help us determine better ways of looking at the market. The first indicator I like is Fibonacci. Now, that's not in our indicator list because it's not one of the oscillating indicators that sits at the bottom of the screen. It's a different type of indicator. And we've talked about all these different indicators. We talked about Fibonacci and Elliott Wave and accumulation and distribution, Richard Wyckoff. All this stuff is different types of tools that we use, and we use them all one in combination with the other. The problem that most people have is they'll stack like six indicators all at the bottom of their screen, and they're all basically telling them the exact same thing. So that's not really very helpful. So what we need to do is we need to find the best one or two indicators at the bottom of the screen that enhance what it is that we're learning and looking at on the top of the screen. So as a technical analyst, we like price. We're reading price. And of course, the oscillating indicator at the bottom of the screen is also reading price and giving you a different type of view of price as an oscillator. Okay, so what we want to do is we want to have one confirm the other. So if I have a Fibonacci ruler and a trend line or something, or a recurring price pattern, I want my indicator underneath to verify that in that pattern that I'm looking at is either in an overbought or an oversold region. We're going to talk about how to read these charts, but the whole idea is that we're not just using one indicator in isolation. And so the first thing I like to do is I like to turn on Fibonacci bars. And I like Fibonacci bars just because it kind of cleans up the trend, kind of lets you see a little bit where markets are with the view of the trend and where it's at. Now, there's a lot of things that we can do in here. These two indicators that are laid over the top, these are moving averages, and I've got a 100-period moving average and a 200-period moving average. We're going to talk about moving averages here in just a bit, so I'm not going to go into them right now, but basically it's just the last 100 price bars average price, or the last 200 price bars average price. So that's what they are. So that is the first view, and then what we're going to do is we're going to come in and we're going to turn on the bulls and bears. Now, the bulls and bears, you just right-click on the chart overlay, and turn it on. It's right there in your list, bulls and bears. And you click on that, and it turns on the price bar, so they're red, yellow, and green. Now, the reason it does that is it's a very simple process of trying to help you identify when the market's in an overbought and oversold region, or when it's meant to go through a rally or go through a pullback, right? So we want to buy low, sell high. And remember that whenever the market is in a yellow zone with the bulls and bears, it's in the neutral zone of the Fibonacci ruler. So if we draw a Fibonacci ruler across there like this, you can see that that yellow zone is a mathematically calculated Fibonacci sweet spot. So that yellow zone is right here between 61.8 and 38.2. And that's kind of how that works. Now, it's gonna vary a little bit from your physical Fibonacci ruler that you lay over the top. Now, remember, the Fibonacci ruler is the delta cone of probability. So this is your high probability location. So when the market's in the delta cone of probability, or right dead center of the one standard deviation, that's what we're seeing with the yellow. So that's what the yellow is. The yellow is the neutral zone. It's the one standard deviation of the trend. So if the market drops out the bottom of the one standard deviation to the negative side, we turn the price bars red. And of course, above it, if it goes above it, here's the neutral zone. You can see in the previous right there, those are yellow bars. And so you can see that the market rallied out of the top of the yellow bars, and that's why they went green. So they're going bullish. So it come back into the one standard deviation and dropped out the bottom, and they went red. So that's going into the accumulation distribution model, and that is how this indicator works. You'll see it. We'll use it quite a bit. We use this tool quite a bit because it helps us with counting and measuring. Let's go look at another market. Let's go look at Apple. So the Apple market, you can see, came in, and we got the bulls and bears turned on right here. And so that's what's turning the price bars red, yellow, and green. If we turn that off, again, we can turn it off right here. We just right-click on that little tile, and we hit remove, and it comes off. So there's what the market looks like, just a Fibonacci bar. If we take Fibonacci off, that's just what Apple looks like normal. So if you went out to any tool out on the internet, that's what you'd see on Apple. This is the MACD. I like the MACD. We're going to talk about that in just a minute, but let's turn off we don't need these arrows. Okay, so this is your Mac. This is what Apple looks like. If you go out to any trading platform, that's what Apple's going to look like. We like to decorate them up, so let's decorate them up. We're going to come in here. Again, we're going to turn on Fibonacci, and then we're going to turn on the bulls and bears. Now, the bulls and bears is going to turn this price red, yellow, and green. And it's going to put the little blue lights on there. So if we come back over to this little, here we go. We go to the blue light. So this is the blue light system. It was created by J. Wells Wilder. It's optimized after the parabolic SAR. It's a modified version. It's optimized to help count Elliott Wave 3-drive patterns. Hyperbolically integrated into the bulls and bears system, can be used for both exit and entry on the market. It uses a combination with recurring price patterns used in combination with bulls and bears arrows. So this is what the blue light does. So let's pop over there and take a look at it. So you can see if we turn on the bulls and bears, again, we're going to right click, chart overlay, bulls and bears. It's doing the little, see these little blue lights in there? That's what we just turned on with the bulls and bears. So the bulls and bears is a combination of tools. These are the settings over here, and you can adjust it with this slider. This is a sensitivity slider. So as you move this sensitivity slider, you can see that it gets more sensitive or less sensitive and becomes more neutral or less neutral. So it's all a sensitivity slider that's moved right here. I like 72. That's my favorite number to start with. Doesn't mean it has to stay at 72. Most of the time it does, actually. But I like 72, and then I like price bars. So we put it on the price bars. You can take it off the price bars and just have little red and green dots. So you don't have it changing the color of the price bars, because sometimes we just like to see red and green, right? First green candle, make a new high. That's a strategy. But we want to know if that's the bulls and bears is reading it as neutral or bullish or bearish. And we can make these little dots in here. So the dots tell you whether that bar is considered, as far as the bulls and bears is concerned, whether it's considered a accumulation, distribution, or neutral model. So you can see that right down in here that we're getting the first green candle to make a new high right there. So as an example, and that's all down in the neutral zone. So the bulls and bears are calling that a neutral zone. We're getting the first candle to make a new high. That's a confirmation, one of the other. So you can see that if you don't want to have the price bars turned on. So we come back over to bulls and bears, and that's if you want to have little dots. So you can have lines too. So you can just make it a line. It looks very similar to the Bollinger Bands, but it's a little bit different. And then we can come in here and make it little crosses. That's kind of little crosses instead of dots. It's just a little different. And then you make little squares, whatever it looks better on your monitor is really what this is. I like price bars because it just turns the price bars yellow. Then you can see that the price bars, so that's how I usually use it. I just leave it on price bars. And if I don't want it, I just turn it off. So if I want to see the first green candle to make a new high, I'd look for the first green candle out of the yellows. So from yellow to green, that would be my first green candle to make a new high. If you want to see from red, if you want to turn off the bulls and bears, you can just turn off the bulls and bears right here. Just turn it off, and then you can see red to green. But you don't know that it's in the neutral zone. You don't know if it's in the Fibonacci sweet spot. You kind of miss that. But you can do it with your little tool here. You can just come in here and draw that up in there, and then you can see, well, that's why those bars are yellow, because they went into the Fibonacci sweet spot down in here into the delta 1 standard deviation. So it returned to the 1 standard deviation. Just kind of poked its little finger in there. That's all it did. But it did come in there. All right. It's a strong market. So that's how this all works together in combination. So it just kind of helps you. It's another tool to just help you. And it's really good. I like it. And it helps you count your waves too. So the blue lights come in here. And again, we don't generally count the accumulation stage. So the accumulation stage is right here. So this is all the accumulation stage. This is the first breakout of the accumulation stage. So we're going to call that drive 1, drive 2, drive 3, drive 4. Now, again, generally speaking, we don't get 4 drives. That's really rare. We generally only get 3. Drive 1, drive 2, drive 3. Then we get that 4th drive was really unique and rare. Apple was really strong this last year. All the markets have been really strong, especially the tech companies. And then we got our little ABC pattern coming off the top. So this is A, B, C, right down to 130.9, which is a golden ratio number. And then that's where it bounced and started to come back up. And now it's going into a neutral zone again. Look at how many yellow bars there are. It's very neutral. So if we draw our Fibonacci ruler in there, we just grab that Fibonacci ruler, and you're going to see that it's going to kind of line up with those from top to bottom. From this top here goes the A to the B down here, and the market retraced back into that Fibonacci delta cone of probability. And look, it's sitting dead center right now, right here between 61.8 and 38.2. That market, that's why you get all that yellow. Look at all that yellow in there. So it's very neutral. To me, it looks like it wants to come down again. Looks like it wants to break that natural trend line that we draw in here. So we draw our natural trend line, and we look for that market to break and come back down. Is it going to come down how far? We don't know. Probably come down and test the previous lows. It's got this, again, this is your delta cone of probability. So if we were actually kind of to draw that in there so you could see your bell curve is like this, right? And so it's the likelihood of it coming all the way down here is less because it likes to stay in that area. But as it comes down one more standard deviation, 2 standard deviations, 3 standard deviations. So it'd come down here. This would be our 3 standard deviations outside of this particular trend. So that's 3 standard deviations down to here. Is it going to make it all the way down there? It would be nice if it did. It'd come down and touch that 200 period moving average, and we could be some buyers down there. That'd be buying some Apple at a good price. So you got to also take into consideration that it's been all the way down here. So if you go all the way to the long-term delta cone of probability, that would bring us back to between 38.2. It would have to break the long-term one you can see is right here. So between 38.2 and 61.8. So that not too far-fetched to see it come down and touch that previous low. It'd be nice if it did. That's where we'd like to see it so we could buy some. We'd like to buy some Apple. All right. So that's how you do it. That's how you read these charts, and you use those bulls and bears to help you make that accumulation distribution model. Now we're going to go through and learn some of these other oscillating indicators down here to confirm these indicators up here. So this is all one style of trading, right? Our accumulation distribution, bulls and bears, red light, green light, yellow, neutral, working with our Fibonacci ruler. We do that type of analysis. And then we come down and we do the oscillating indicators underneath. We want the oscillating indicators to confirm what we're seeing on top. We don't want just six oscillating indicators all confirming each other. We want our oscillating indicators to confirm the work that we're doing up on top, the mathematical models that lay on top of the chart. That's how you say one confirms the other. You don't just have 6 oscillating indicators all confirming each other. That wouldn't make sense. Okay, let's see where we get to. All right. So now the next one we want to talk about is the zigzag tool. The zigzag Fibonacci and Elliott Wave Enhancement. It's another tool very similar to the bulls and bears, but it doesn't have color coding. So primarily used for trend confirmation, not used for entry and exit. It eliminates trend noise, calculates Fibonacci and Elliott Wave trends and retracement. So let's go look at that. It's a neat one. Let's come in here and delete all the drawing tools, and we're going to delete off the bulls and bears for now. Although the zigzag can be used in combination with the bulls and bears. I'm not going to use it right now. We're just going to leave it turned off. Let's go ahead and turn off the moving averages too, just to clean the chart up. I'm going to get rid of these orders. We got some orders in here that we were practicing with in another class. So let's go and we'll go view, hide all on-screen options, all stocks and options. Yes, let's hide them, view, hide options. Yes. So just clean the chart up. All right, so there's our standard Apple chart. So let's come in. We're going to right-click on the chart overlay, and we're going to come down here to the zigzag. And the zigzag is the Elliott wave. Now, the zigzag is kind of a tool that was designed a long time ago. I don't even know who did it. Did it say? But we modified it so much, it's not even the zigzag anymore. In track and trade, we changed it around so much that if we come in here to chart overlay zigzag, yeah, I don't even know who did this math the first time eons ago. But what it does is it actually just calculates your trend. So see this trend from the low to the high. That was a 465% projection with a 47% retracement. So it went from, actually we go with, well, that's 99. This one projection from this top to this bottom, that's what it's going off of. So this is your one run all the way from top to bottom. We're going to call that 100. It's a 100% run. And then it had a 47% retracement pullback. That's what it's calculating. Does that make sense? So let's come over here and let's make these fonts bigger. See if we can make them bigger so you can hear and see them out there on the YouTubes a little better. And let's make them bold. There, now you can see them better. So how's that? So what we're going to do is we're going to use it to help us mathematically calculate these trends. So you can do it with the Fibonacci ruler. You can come in here and you can draw from the very low to the very high and pull it out. And you can see that it came back right there, from there down to there. Not quite 40, not quite 50%. 50% would have been right here. There's 47%. So that 47% is telling you how far back that market came against that. And that's coming back into the delta cone of probability, right? So that's how the zigzag works. Now, the zigzag has a tuning fork on it, a little tuning fork. So we're going to come back to the zigzag, and we'll see this little slider right here. We can slide this down. Oh, it's going too fast. And we can go down to the size that we want to have it calculate. Where do we want to have it calculate? Now you can hit the auto scale. If you hit the auto scale, it's just going to put up on this one just one great big trend. You want to kind of tune it in. It's like you ever drive around in an old Ford pickup truck? Turn on the radio and you had to tune it in. You know, not digital radios nowadays. You just push a button and it finds the station. And that's what this is. This is your digital auto scale button, and it just finds a station, but it's not tuned to the where I want it. I want a different channel. So you have to tune it like an old Ford pickup truck radio. You have to turn the dials and find the right spot. And that's what this is. This is your dial to find the right spot. I want it to measure for me these highs and lows in here. So I come in here and I slide this down, and then you can see where it kind of just tuned it in to where it gives you these highs and lows. See that? Now I can see a little bit better. From this pullback to this one here, this was 169% projection against this previous run, but it was a 61% pullback. And then it rallied up 217% against this run down and created a 46% pullback right there. So if you sat here and did all of this with your little Fibonacci ruler, you'd come in and you'd draw all these in, and it tell you, well, that's right there. It came back almost 61.8. No, it came back to 65%. So you could do it manually with your little measuring tool, or you can just have the zigzag measure all these things for you. So see, this comes back 46%. And then it tells you, this one here we'd have to tune it in again to get it to do this one. Only came back to about 38. This one here, all the way to the top, came back. Now it's turning around, going back down the other way. So the zigzag does that math for you. So down, it's come back, and it retraced from the top to the bottom. So if we take our Fibonacci ruler, go from the top to the bottom, it pulled back to, on the Fibonacci ruler, the ruler just says 78.6. And you say, well, it went a little bit past. Well, the zigzag tells you it was exactly 83%. So that's pretty cool, right? And then you can see all the little patterns that it makes. So we're coming into a little, kind of helps you identify those recurring price patterns. So remember how we talked last night? We talked about wedges and wedges and triangles, and how the markets come into kind of into a point where a lot of pressure, and then they break out. So this is that point right here, and you can see the zigzag kind of helps you identify those points like that when you got lower highs and higher lows. So it's coming into a point, and it generally breaks out. Now sometimes what we get is we get a fake one way, and then the market turns and goes another way, and that ends up being a pattern in itself. That's called a little butterfly pattern. We didn't talk about that one last night, but this is a little butterfly pattern. So we call it a butterfly because it looks like a butterfly comes down. If it did that, and then you see the little butterfly wings, we attach them like that. That's called a Gartley pattern. If you want to look those up on the internet when you got time after this class, remember, write it down on a piece of paper, Gartley patterns. And these are little Gartley patterns that we look for, and they kind of help us identify when markets are going to move in which directions based on the little wing patterns. And so you can look up Gartley patterns. They're all over the internet. Lots of people talk about Gartley patterns. But that's what that is. It's basically a breakout of a wedge or a triangle formation, and then it comes down, makes that false bottom down here, testing this location right here, and then usually we see it take off like that. That's a Gartley pattern. So there you go. There is the zigzag. So let's go over, and you can play with that one. It's really cool. You're going to have a lot of fun playing with that tool. And now we're going to come in here, and we're going to go to the ATR, average true range. This is, see how this one, I got it, one of our superstars. I use this one a lot. I like this. And you'll notice that a lot of the indicators and tools that we use come from J. Wells Wilder. He was a smart boy. He created most of the popular indicators in the industry that we use today. The average true range, ATR, is a market volatility indicator. In fact, if you can get any book from, I usually have his books sitting right here on my desk, up in my cabinet. But J. Wells Wilder, any book that you can get from J. Wells Wilder, you should buy it. I just bought one. It was like $112, and it was just a little thin book. Really good book. Kind of the stuff that with the Fibonacci projection tools, it kind of shows you. He wrote a book about all that stuff, and it's all in the track and trade software. So all this Fibonacci stuff, that's what he did. He did all the Fibonacci. He's done the average true range. He did the Fibonacci projections. All that kind of stuff is in that book that I bought. It's a little green book. I can't remember the name of it, but it was like $112. You can't buy them new. They're not published anymore, so you get used ones. Anyway, he's a nice, anything you can find on J. Wales Wilder is going to be good stuff. The average true range, ATR, is a market volatility indicator. It is generally derived from a 20-period average and a 2.0 stop factor against the trend of the market. It's a trend indicator. The ATR was originally developed for use in commodities markets, but has since been applied to all types of securities. This is my go-to indicator for short-term day trading. So when you see me day trading, this is the tool I like the best. This is my favorite one because it sets up your entries and your stops. So because it's the ATR, I use it as it's got a stop factor in there. So it's factored, it mathematically calculates where you should put your stop against the trend. Now, of course, it's user definable, so you adjust it. But let's go turn it on. Let's come in here, chart overlay. Let's get rid of all these drawing tools. I'm going to right click, delete all drawing tools. And let's turn off the zigzag. And we're going to turn on right click, chart overlay. So we got overlay indicators that lay over the top of the chart, and we got underlay indicators, what we call oscillating indicators, the ones that oscillate underneath the chart. So we got two windows in here. These are your windows add indicator window. So these are all the ones that go underneath the chart, and then overlay indicators. These are all the ones that lay over the top of the chart. So we're going to come in here and we're going to go chart overlay, and we're going to come into the ATR. This right here, ATR. I love the ATR. It's my favorite, one of my favorite indicators. And the reason is because it's just a basic moving average with a stop attached. So you come in here in ATR period. Now, generally speaking, a 20 is the starting point. And that's where J. Wales Wilder kind of developed it to go with the market at a 20. And then the stop factor is wherever you want it to, how strong of a stop, how big of a risk you want to take against the market. Does that make sense? See that? So you just move it as your stop, because what you're going to do is you're going to get into the market. So let's say you get in right here. So you get in right here, and then you put your stop on the yellow dot. So every time the yellow dot moves, you're going to advance your stop. So the stop meaning, of course, is an order that gets you out if you're wrong. So you get in here, and then you have a stop order that stops your losses. That's why it's called a stop order, stops your losses. Now, we can use stop orders in many ways. We're going to get into that on Friday. We're going to talk about order placements and different strategies that you can use with orders. So then you just put your stop order to get you out of the market on these little dots. And every time the little dots move closer, you just inch those dots forward. So you can put those as far away as you want or as close as you want. And so you come in here, and I like them a little bit tighter. So I just move them up like that. And you can, again, it's just kind of like the Ford pickup truck. You dial them in based on what past performance of the market is. Past performance not necessarily indicative of future results, but it's the best we got. So we look at what the market's been doing, and we dial in our stops to the placement of where we feel comfortable, where we would want those stops. Now, if you want to get stopped out in between each individual little ABC pattern, so you're like, well, we can come in here and we can turn on the bulls and bears. So bulls and bears is right here. Now we have our drive patterns, right? So we can see drives, drive 1, drive 2, drive 3, drive 4. I know it gets a little confusing sometimes. You got too many indicators on the screen, so you have to be careful. But the stop and the blue lights, you can use the blue lights as stops too. But notice how the blue light holds your stop back here a little bit farther in the beginning. It's a little safer, right? But also, you're not going to get stopped out on an accident, but it's also a big, if the market flushes, you're not going to get stopped out till clear down here. Whereas you can use your little yellow dots you use the blue dots to count the waves and the yellow dots to determine where you're going to put your stop. So you get in, like right here, right? If you decide to get in on a break above the first green candle, make a new high, or break out of that yellow bar, that's where you get in. And then where are you going to get out? Well, you'd get out. The next arrow would be up here, and that's when it crossed the ATR. So you can see we can adjust that, and that would go up or down depending on where it is. See, and then if we get a little tighter, it crosses here, crosses there, crosses here, crosses here, crosses here. We're getting a little too tight. We get stopped out too often. Or you can pull it way back and not get stopped out until way up here. So it's just where you feel comfortable. What kind of trader are you? You want to take little shorter trends and get in and out of a market? You're a little bit more cautious. So I like to go, when we start like this, you can put it on 20 for the ATR period. This is a daily chart. When I go down to a 1-minute chart and start day trading, I'll put this all the way down from 20 all the way down to 1. So I'll go from 1 and 1. and you'll see me do that. Yesterday we did that. I used the ATR for my entries and my exits, but I don't just exit because I got an arrow, and I don't just enter because I got an arrow. I use the reoccurring price patterns. I use the first green candle make a new high, but I use the arrows to identify for me where the trend is. Is this trend bullish or bearish? And I use the ATR, the average true range, to help me determine whether I should be taking long positions or whether I should be taking short positions. And it's a nice little tool. It's different than the blue light, but it's similar. You kind of use them in combination one with the other. But the nice thing about the yellow dots is that you can adjust those stops. You can make them tighter or you can make them looser. You put them right where you want them. So how aggressive do you want to be on the market? So, you know, and what you can do is you can be very aggressive at the beginning of the trend. Once you get the stop moved to break even, where you can't lose any money, if the market comes down, it breaks you, then you can loosen up your stops and hold them back farther, and then you can stay in a market for a longer run. Does that make sense? I hope that makes sense. All right, so that's a neat tool. I really like the ATR. We use it a lot. We use that one a lot. So here's the next one, is RSI, Relative Strength Index. Now, this is where we're going to start going down and start looking at the oscillating indicators. So the first ones we've been talking about have all been up on top, covering up the top chart. Now we're going to go start looking at the oscillating indicators underneath. And the first one we're going to look at is one by J. Wells Wilder again. So J. Wells Wilder created the RSI, or Relative Strength Index. Now, we use these in combination with the others. So he created the ATR, which is the little yellow dots, and he also created the blue dots. He also created the RSI, which lays underneath. So they're meant to work with each other and enhance each other and confirm each other. So that's how they work. So the RSI is the Relative Strength Index. It's a popular momentum oscillator developed in 1978. The RSI provides technical traders with signals about bullish and bearish price momentum, and it's often plotted beneath the graph as an asset's price. An asset is usually considered overbought when the RSI is above 70 and oversold when it's below 30. So it's basically the delta cone of probability. That's what it is. So if we come down here, I'm going to turn off the MACD, and I'm going to turn on RSI. So RSI is on, MACD is off. And so now you can see, let's see if we can make it a little brighter for you. All right. So now we can see, it kind of took away our trend of the market. So let's kind of move that down. All right. So this is called the overbought region up in here, overbought. Anything that's up in here, anytime the line's up there, that is at the top of the delta cone of probability. So this is up in the upper region of the delta cone of probability. This is in the lower region of the delta cone of probability. I can't get the right tool. So this is the lower region of the delta cone of probability, and this is the center of the delta cone of probability. So if you were to draw your delta cone of probability, you'd have it look like this. All right. So we just take a bell curve and we turn it sideways, because everything in trading is sideways. Nothing sits this way in trading. Everything is sideways in trading. So we have to turn our indicator. We have to turn our delta cone of probability, our bell curve, sideways. So this is where the market will stay most of the time. It's going to stay in this region. Anytime it's in here, it's considered neutral. It's in the one standard deviation. Anytime it goes up in here, it's left the one standard deviation to the upper side into the upper region. And anytime it comes down into this region, it's left the standard deviation to the downside. So that means that this ends up being basically like, well, standard deviation. The market wants to come back to the standard deviation. Now, it's based on a 0 to 100 scale. So you can see this. It starts down here at 0, and the scale is 100. So it can't go to 120, 130, 140. Can't do it. It's stuck at 100. It's just the nature of the beast. Now, we got other oscillating indicators that are based on the delta cone of probability that don't have tops. They're dynamic. So if the market just keeps going up, well, the indicator can just keep going up too. This one cannot do that because it stops out at 100. Once it gets up to the top, it can't go any higher. It's just the nature of it. You just have to realize that there's multiple ways of calculating the same thing. So this is where we come along. Let's clean up. Well, we'll leave those on there for now. So let's come in here, and you can see right up in here, when the market gets up in here, it's overbought, meaning that we anticipate a retracement or a pullback. It came back down into the delta cone of probability, and that's just like it calculated it to be like right in here. And then it turned and started to go back up again. So it's like, well, it's overbought up in here. So see how it corresponds with the upper here, up here, not here, get rid of this one. So then see how it's way up there, and then we get another one. Then it drops back down into the 1 standard deviation, back down into here again. That's this pullback right here. And then the market turned and started to rally up again. So it rallied up again, and now we're outside the 1 standard deviation, and we're considered to be overbought way up in here. This is all overbought region. And then it popped up one more time up in here and got this overbought region. So it pulled back down in this little one. These little pullbacks aren't as big as, they look bigger down here. And then as it pulls back down, now we get a really big run all the way down into the bottom side. So it went down through the neutral zone, which is right here, all the neutral zone. And then we went down into the red zone, which is right here. Now we're in the oversold region. So this is overbought, this is oversold. When it gets down here, we generally anticipate that the market's going to turn and rally once again. And so we can see that oscillating indicator. And so that mathematical model tells you that. And then you notice how they confirm one with the other. So we're yellow here and we're neutral here. So that's what you want to see. You want to see, when I say that one tool confirms the other, you're not talking about this tool confirming the MACD, or the MACD confirming the RSI. You're talking about the RSI confirming the tools that are up on top, or the price action that you're seeing, or the Fibonacci ruler, or the delta cone of probability up on the top chart versus the bottom chart. You want those two to confirm each other, not just a whole bunch of indicators confirming each other. That's not going to do you any good. So then we have this one here, and we have this way up here. So this tells you, hey, we're way up here in the overbought region. So as that market starts to approach way up here, and this is way up here, you can say, hey, there's a chance that thing's going to fall again. The chances of that going any higher is pretty low because it's already in the way over here in the overbought region. And then it flushes back down, goes yellow. So it's in the neutral zone. And so you can see right now the market is sitting dead center of the neutral zone with the RSI. So if you come in here and we draw our Fibonacci ruler from high to low in here, that should confirm one to the other. If it doesn't, then you got a mismatch of your indicators, and you probably shouldn't take a trade. So now what we've got is we got a confirmation. Are we in the neutral zone? Yeah, we're right dead center, 3861.8, based on the previous trend, based on where the bulls and bears is turning all the price bars yellow, and it's sitting right dead center of our Fibonacci ruler between 38.61. So, okay, so we slide down to the RSI. Is the RSI between 30 and 70? Sure is. Oh my goodness, they match each other. That's a confirmation. So this one is confirming this one is confirming that one. They match up. Boom, we got our answer. The market's neutral. Market's neutral. So that's what we're looking at right now. We're looking at a neutral market. And so do we want to buy on a neutral market? No, not really. We generally want to buy and sell when the market's in extremes, extremely high or extremely low. And most of us want to buy low, sell high. So we want to wait for the RSI to get down into these regions here, which is, remember what we talked about, the accumulation stages, when markets go down into these red zones. And this is where the RSI comes in and tells you, hey, you're down here in this accumulation zone down here. And now we're going to go up here. And when it crosses over the neutral and up into the other region, now we're going to sell up in here. So you're going to buy low, sell high. That's how you confirm one with the other. And it's taken us a long time to get here, but that's the whole game right there. You got your entry points that are determined and calculated by your recurring price patterns, confirmed by your mathematical models. Generally speaking, here with the blue light system and the ATR, telling you where to stop and get out of a market when the market moves. You got your RSI down here confirming that what you're looking at up here on top with the Fibonacci ruler, your delta cones of probability, and your accumulation distribution Elliott wave patterns being drive 1, drive 2, drive 3. And then we got fourth drive up there, really rare. So that's how we trade. That's how we build ourselves a trading model. Now, there's other indicators that you can use that can help you swap out the RSI that might give you a little bit more information. So as we move through, we can look at some other indicators. So the next one we want to look at is called the stochastics indicator. Stochastics is the delta cone of probability indicator. Again, it's developed by George Lane in 1950. Stochastics is a momentum oscillating. Closing levels near the top of the range indicates selling pressure. It's overbought, and the nears to the bottom of the range oversold. So it's exactly the same thing as the RSI, but instead of having one line, it has two, and the threshold is a little bit different. That's all it is. It's a little bit different. So we're going to come in here, and I'll turn them both on at the same time, and you can see they're almost identical. See that? They're almost identical, but the thresholds are a little bit different. You turn on your thresholds right here, 80/20. That's just kind of the defaults. And so we're going to turn off the RSI now. And you'll notice that the stochastics is almost identical. The difference is we have a little bit broader outlier out here. So the market has to be a little bit more aggressive to get up into those overbought regions. And so and then you got two lines. So when the two lines cross, whereas the RSI only has one line, it just has to dip and curl, and you realize that it's up above the threshold. It's up in the upper region. So this one actually has two lines, so the lines cross, and people like crossing lines because that's kind of a stronger confirmation. And you can turn on your little display here of your arrows, and you can see where the lines cross is where the little arrows come in. So what's happening is you're getting crossover here, you're getting a crossover here, you're getting a crossover here, and that's why you get these little arrows down here crossing to the upside. All right. So all the little buy signals in there telling you buy, 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 all the way up the uptrend. So because you're getting crosses down in here. So if we come back to stochastics, that's the nature of the beast. So these are all your settings, 14.3.3. We just use the defaults. That's how George Lane designed it. I actually talked to George Lane on the phone one time before he died. I didn't get to meet him in person, but I did talk to him on the phone once. So that's the stochastics. Stochastics RSI, basically the same thing. Overbought, oversold region. Now you can use this for you can use it for what we call convergence and divergence, but we're going to talk about convergence and divergence in another indicator. Just realize that you can apply convergence and divergence to this indicator as well, also to the RSI, but we'll talk about what that is here in just a second. All right, so they just confirm one with the other: overbought, oversold, overbought, oversold. Overbought just means that it's up into the it's up into the second or third standard deviation. Oversold means it's gone down into the second or the third standard deviation to the downside, and so the probabilities are it's not going to go any lower, probably going to turn around and go back up. All right, let's get rid of all of the drawings. Delete all drawings. Let's go to the next one. So now we're going to go to this one here. Okay, this is where we're going to talk about the MACD. This is called, this is chalk and money flow. Chalk and money flow, accumulation distribution model. This is a really good one. Developed by Mark Chalkin in 1980s, developed to identify whether a stack is being bought, accumulated, or sold, distributed, a stock by major players. Core logic: if a stock consistently closes in the upper half of its daily range on a higher volume, the CMF rises, signaling bullish strength generally created by large institutions. So this is a large institution. Now remember, when we do the Richard Wyckoff accumulation distribution model, this is a tool that we really love. All right, so we're going to come in here and we're going to turn on the the chalk and money flow, CMF, and we're going to turn off the stochastic. Now you see me use this one all the time because it corresponds almost identical. Let's get rid of the ATR for now. It corresponds very closely with the with the bulls and bears. So the bulls and bears is telling you when the market's going down into the broke out below the Fibonacci sweet spot, right? So if we take our Fibonacci ruler in there, we draw that in. So we've now gone down into the Fibonacci sweet spot right here. This is the neutral zone right here. And then it's broken down and it's gone down into what the big boys look at as the accumulation stage. So they're letting the market flush down and they start buying down in these regions here. So what happens is this tool comes in here, and because it's designed for the large institutions, it's telling you should be buyers down in here. Does that make sense? And then this is where you sell. This is where the big institutions are selling. That's why it's red. And then this is where they're buying, which is why it's green. Now, if we come over here to the chalk and money flow and you go to TNT defaults, they actually turn it the other way around. So LAN takes this tool, and because I don't like the way the programmers put this in, I want it this way. So my defaults, this is how I set it up. So this is the way you want to set it. So take a picture of my settings. All I've done is flip this color and upside down. So this is the way I like it because it corresponds with what we're trying to do here. We're trying to be buyers when markets are pulling back. This is where you want to be a buyer. This is where you want to be a seller. Very simple. That's all there is to it. Now, because this market was going up, up right in here, and then it had little tiny pullbacks, we got little tiny buy zones right here, little tiny buy zones right there. See how we got that? And then down in here, this is the accumulation stage. So this is where the big boys, the big banks and hedge funds started to accumulate. So they start accumulating here, and that's where we want to be buyers. We want to be buyers in these locations here. And then the market came down one more time, went through this big, long accumulation stage right here. And then this is where the big boys, they start selling out. So once the market starts going up, retail traders, we start to buy all the way up the uptrend. Well, for every buyer, there's got to be a seller who's selling to you. The big hedge funds, the big banks, they're selling all the way up this uptrend. That's why this is all red. Then they slow their selling, and then they sell some more, and they slow their selling. Then we go into a buy zone. Pulled back far enough, you can get a little bit, you can go through another little accumulation stage. That's what this is telling you. And then you got this sell, 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 sell. Get rid of your shares. That's what they're doing. They're selling out all the way up there. You're buying. They're selling to you. They're making profits from all the shares that they bought here. They bought all their shares through here. See, they did the accumulation stage, and then they sell out all up that. They build their pyramids this way. Retail traders, we build our pyramids upside down. That's why we lose money. So that's how the chalk and money flow works. And it's really cool. I like it. Love it. It's a great tool. So now we come in here, and the next one I want to talk about is the MACD. Now, this is the premier Delta Kona probability calculator. It's what we call the moving average convergence divergence. So we're going to go take it one step further. It's created by Gerald Appel, 1960s. MACD is, I think it was Gerald Appel I talked to. Who did I say I talked to? George Lane. No, I think I talked to, I can't remember. I think I talked to George Lane. I don't know. Maybe it was. No, I don't think. I can't remember whether I talked to George Lane or Gerald Appel. I didn't talk to both of them. I only talked to one of them on the phone a long time ago. It was 30 years ago. I can't remember which one I talked to, Gerald Appel or I think it was George Lane. Pretty sure it was George Lane. Anyway, MACD is calculated by subtracting the 26-period exponential moving average, EMA. We just asked him a few questions. It was just kind of like he was being nice to us, and we called him from the Board of Trade. The guy I was with had worked for him at one point, and so he says, "Let's give him a call and see if he'll talk to us." So we just called him, and he's pretty old. And we were just like, "Hey, just calling to see how you're doing." It wasn't like, yeah, here with Land Turner from the Board of Trade. We're down here teaching at the Board of Trade. Just wanted to call and see how you're doing. It was one of those conversations. It wasn't like we're like, "Oh, let's talk about the MACD." No, we didn't do that. He's basically on his deathbed. All right. So anyway, MACD calculated by subtracting 26-period exponential moving average from a 12-period moving average. So really, if you think about it, oscillating indicators that are down in the bottom, there's nothing magic about them. They're just a different way of displaying moving averages. Everything is just basically an average of price. That's all we're doing, just averages of price. MACD triggered technical signals. When it crosses above to the buy side or below to the sell side, it's basically the same thing as the overbought, oversold regions. And then we have helps identify bullish and bearish trends through strength and weaknesses, convergence and divergence. So I'm going to show you how that works. So we're going to come over here. It's basically the same thing as some of these other tools, but it has an extra couple components to it that we really like. So we're going to take the MACD. MACD, a lot of people use the MACD. So the MACD is used by a lot of traders. And because it's used by a lot of traders, it gives signals. And so the large institutions will play against this. So you got to take that into consideration. They probably, they like to see what retail traders are doing, and then they play the other side. And this is a very popular indicator. So what we're looking at is basically the same idea as what some of these other indicators are. You got the Delta Kona probability in here. So you come in, and this is it's called a histogram. So the very center across the middle, this is the zero line of the Delta Kona probability. So that's going to be delta 50, right? So right across the center, delta 50. And so anything above that is going up into, again, we'll draw our little Delta Kona probability in here. It's going to be the same little strategy. You're going to be like this. So anytime the market's right here, it's neutral. So you're going to notice that when the market's circling around, and this one doesn't have, it doesn't generally use thresholds. You can put thresholds on it, but the problem is that this one isn't a 0 to 100 scale. So those thresholds are they're gonna migrate, because the higher the market goes, it'll keep squishing it down. There's no top to it. Like RSI and stochastics is based on a 0 to 100 scale, so it can't go any higher than 100. But this one here is dynamic. It doesn't have a top. So it'll just keep going up, 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 up as long as the market keeps going up, 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 up. It'll just keep going up, up, up. So you get your 3 drive patterns in here. So you're going to see drive 1, drive 2, drive 3, drive 4. You're going to see that in here. You're going to reflect it, drive 1, drive 2, drive 3. And then you can see drive 4, as it started to get up here, it started to drive, even though we're making higher highs in the market, So this is a high, and this is a high, and this is a high. 3 higher highs, another high, another high. So all these highs, higher high, higher high, higher high, higher high. We're making higher lows, low, higher low, higher low, higher low, higher low, right? Even this one, higher low. This is a higher low. So it didn't really go bearish until right in here, until it broke that line right there. See that? So that it wasn't a confirmed bearish market until right there. But look at what the indicator started to do. This is one of the powerful things about this. That's why it's called convergence divergence. So see how this market started to make lower highs? So the indicator itself is making lower highs, but the market is making higher highs. Well, that's a problem. That means that this market is losing steam, running out of energy. So the indicator is telling you, hey, this is not a very strong higher high. And this is even a weaker higher high. So this is telling you we got 3 lower highs, even though we're getting higher highs in the market. It's telling you that that energy of that market is dying on you. So be really careful buying up in there because it's losing its strength. It looks strong, but the indicator is telling you this is called divergence. So divergence is that we got higher highs in the market and we got lower highs in the indicator. So that's telling you the market is weakening and it's going to die. And so it did, and it weakened right here. And down it went, whew, flushed all the way to the other side, into the other side of the delta cone of probability, down into the oversold region. So that's where we come down here. And then you see that this thing, see how the color change right here between red and green? That was the absolute bottom, and that happened right in here, right here. So you get that little confirmation down here. That's why people like this tool, because it's got that color code. If you come in and look at the chalk and money flow, you get the buy down there, but we don't have that little color change. Now the chalk and money flow is a little bit different mathematical model, you can see, but it's almost similar. It's so close that we can sometimes just like, well, I'm just going to use the MACD. I'm not going to use the chalk and money flow because they're almost identical. They do about the same thing, a little bit different, but pretty much the same thing. So we're going to remove the chalk and money flow, and you can just use the MACD, and the MACD tells you right down in here, it gives you that one extra little thing that you can look at is the color change from red to green, and then that occurred right here. So that's kind of a nice little thing to look at. But you want to make sure you're corresponding with what's going on up here on the chart. Realize that, hey, this is a nice little ABC pattern. And so it's down here at a 130.9, and that's occurring right here at the right spot. And so again, they're confirming one with the other. You're making sure that this is matching what's happening down here. If you don't have a matchup and they're doing weird things, you got to go, oh, wait a second, I'm not sure I want to do that. Market's making higher highs right here, but yet the indicator's making lower highs. That's a mismatch. That's called divergence. That's not convergence. If convergence is when you're making higher highs and higher lows, and the indicator's making higher highs and higher lows, that's good. That's the strong trend. Buy into that. Make money. But as soon as it stops doing that, starts making higher highs, and the indicator tells you early, hey, watch out. This is an early indicator that market's losing strength. We're getting lower highs on the indicator. That's where you're going to tighten your stops and worry about this market turning around and flushing out. So that's the MACD, and we use the MACD a lot. We like the MACD. We can use the MACD in place of some of these other tools. RSI, you can use MACD instead of RSI. You can use MACD instead of stochastics. You can use MACD instead of momentum. You can use MACD instead of the chalk and money flow. But just realize it's not perfect. It's not perfect. It's just pretty good. It's pretty darn good. We like it a lot. It helps us identify a lot of tools, a lot of confirmation. All right, so here's momentum, measures the rate of acceleration of rate of change. That is the speed at which the price is changing. Convergence and divergence indicator, higher highs in the market, lower highs in the indicator. So you got the same event occurring here. It's not quite as sophisticated as the stochastics. We'll turn it on, lay it over the top of this as momentum. You can see that when you lay it over the top, and the reason I have mine black is because sometimes I like to have it just kind of quiet in the background. So you can move it in the background, you grab this little tile and you can move it up there like that. And then you can see that the momentum on this market is much higher. It's represented much higher on the momentum indicator than it is on the MACD. So I can see that I'm losing momentum a lot faster than the MACD is represented here. So the MACD says it's coming down. It's more of what the trend's doing, but I can see down here that the momentum is poking out down underneath there a lot stronger. It's a lot stronger downtrend than what the MACD is indicating. So that's why I have it black. That's just my setting. Again, I told you I would show you my settings, so you can take a picture of that and make yours look like mine if you want to. You have to realize why I do what I do, because I lay it behind another indicator. It's not meant to be it's not meant to be the front and center indicator. It's a quiet one that sits behind to show the differences between momentum and the mathematical model that in this case is the MACD. Because what we'll do is we'll sometimes come in and we'll remove the MACD and we'll turn on the chalk and money flow. And so chalk and money flow, again, I do the same thing. I've got the momentum sitting behind it, so I can see where momentum is stronger than what the indicator is showing me. So I got really strong momentum right here. See this to me is an important thing to take a look at, because I've got in this trend, that's a really strong momentum trend. Really got a lot of momentum in it. Now this little indicator is showing divergence. So it's coming in here and it's saying they're not doing as much purchasing in here. So or selling in here. They're selling less in there. And that's what this is telling you. So you got this strength here and lower high, but higher high here. So the momentum is saying, hey, wait a second, this is a lot stronger than what that indicator is showing you. The momentum on this stock is a lot stronger than that chalk and money flow is showing you. So that's why I like it kind of sitting behind, just quietly helping me have a little bit better view. There's just two different mathematical models that are very similar. One just shows you the momentum's a little bit stronger. And that's all it is, and that's why I have it black, and that's why it sits behind the market. And we can do the same thing. We can turn off the chalk and money flow, and we can turn on stochastics or RSI. So we'll turn on RSI. Now I got my RSI in there, and I can see the momentum in combination with the RSI. So the RSI is in the overbought, oversold region, and I can see that, hey, look, right here, for example, RSI is way up here in the oversold region, way up here, but look at the momentum. Momentum's way weaker. So that momentum is saying, hey, that's not a very strong overbought region. With losing momentum and the market's way up in the overbought region, that's a really good sign that that market's going to flush out. The momentum is lacking. Now this one here shows high momentum. See that? Really high momentum, and we got this up in the over region is really high momentum. That's why it didn't flush out and make a big red move down in here, is because it had really high momentum. See how high the momentum is? But yet here the momentum's really low, yet the RSI is way up here. So that's telling you that's not a strong run. It's got a lot of weakness in it. And sure enough, that was the last one, and down it went. So you just kind of have to learn how to read it, and you just have to use them for a long period of time, get used to them and comfortable with them. I'm just showing you my little tricks, and you can take my little tricks and apply them and use them if you want to. Make them your own. All right. So now let's look at the next one. The next one is the Bulls and Bears advantage lines. Now this one comes back. It's a hybrid of moving averages. Let's talk a little bit about moving averages. I told you I was going to go into moving averages. Let's first talk about moving averages. So let's come in here. And when traders started to trade back in the early days, one of the very first, let's turn off Bulls and Bears. One of the very first things that they ever, let's turn off Heiken-Ashi. So one of the very first things they ever did was like, hey, this is the price of something. Let's come in here and let's make a average of those prices, because they're jumping all over the place. Let's create an average of those prices. So they came in and they said, okay, we're going to mathematically calculate the last 50 bars. So they said, okay, this is what it looks like if you just the average price of the last 50 bars. So they take the highs and lows of each one, add them all up, divide them by 50, and that gets you this line right here. And that was really cool. And they were like, wow, that's the average price of market prices. So they used this moving average. And that was like, oh, that's amazing. We're so smart for having come up with that idea. And then another smart guy come along and he says, you know what? If we use two of them, let's do a 50 and let's also do a 100. And then we're going to do a 50 and a 100. And look at that. Now we got two moving averages, 50 and 100. And notice that when they cross, this guy, real smart guy, he says, when they cross, we know that the market is changing from bearish to bullish, or from bullish to bearish. So there you go. There you see a 50 and a 100 period moving average. When the market crosses, the 50 goes above the 100. That gives you a crossover, and that's where the market turns bullish. And then they say when it turns the other way, you get another crossover. That's when the market turns bearish. So that was a very first indicator ever created. Oh my gosh, that's really cool. All right, don't we love that indicator? Oh, that's the neatest thing since sliced bread. We're going to use that all the time. And still to this day, they're some of the most popular indicators ever created. In fact, every single thing you see in here, all these oscillating indicators, all this stuff down here, they're just moving averages. looked at in a different method, just apply it in a different way. Everything's just a moving average of price. So everything is built into price, and everything is moving averages of price. So now we come in, and what we're going to do is we're going to say, let's take these moving averages and we're going to make them shorter so that we can trade these little smaller pieces of the market in here. Because not everybody wants to buy here and sell there. They want to buy and sell in these shorter areas. So we come in here and we're going to drop this down. We're going to say, let's drop it in half. Let's go to 25 and let's go to 50. So what happens is now you get, oh, now it's even more. Oh, wow, that's really cool. Look, we get a little bit more accurate. It comes up here. And now we got a little earlier time frame. So now down in here is where it crossed. And so, oh my gosh, isn't that even better? We got even a better look at where it's at, not quite so stretched out. And then I say, well, if we could do it that way, let's go in a little closer. So they said, let's make it down here. Let's go down to 12. Let's make it 12, and let's make this one 25. And so what happens is you end up with this little situation where you're like, oh, wow, that's really cool. But now you get all this, what we call whipsaw. You get one entry here, and then you get another one here, and then you get another one here. So you get all these little entry spots, entries and exits, right? Little crossovers. And then they came in and they said, well, let's go even closer. Let's come down here. Let's go down to a 6, and let's go down to a 12. And now you're trying to use your little moving averages in here, and you can bring this one in even closer. 6, let's go down to 8. And so now you get little crossovers at the top and the bottom of each one of these. See that? And then you get a little crossover here, and then you get a little crossover there, and then you get a little crossover here, and you get a little crossover here, and a little crossover there, and there's another little crossover in here, and another little crossover in there. So you get all these little crossovers for all these little spots. The problem is you get what we call whipsaw, or delayed reaction. So the market's crossing, and then you get like 3 or 4 crosses, and then you get another delayed action, and another 3 or 4 crosses, another delayed action, another 3 or 4 crosses. So what we did is we come in and we said, well, there's got to be another way of calculating moving averages. So we created one that has less whipsaw. It's a hybrid moving average system, proprietary formula, significant reduction in whipsaw. So you're not getting so many little crossovers, but you're getting your early entries and late and early exits. The problem with moving averages is that if you make them too short, you get lots of whipsaw. If you make them too long, you get late entries and late exits. So you have kind of a lag if you make them too long, and you get too many crossovers if you make them too short. So what we did is we took the mathematics and we crossed over the mathematics into a different mathematical formula, and we made it so you don't get all the whipsaw. Let's make these a little brighter so you can see them. Oh, that's the circle tool. Let's come back over to moving average. I'll make these brighter. You see them a little better. All right, so you're getting lots of, like right in here, you're getting lots of whipsaw, in and out, in and out, in and out, in and out, as you go through some of these different zones of moving averages. So if we take the chart overlay and we go in and we turn on the advantage lines, the advantage lines are going to give you, and let's go and put these at the same, what do we have? We had on the moving averages, we had them at 6 and 8. So we're going to put this one at 6 and this one at 8. And you see it's just a little bit different in the sense that you don't have all the whipsaw that you get of the standard moving averages. It's just a different mathematical model, just a different way of calculating moving averages. But it comes in a little bit earlier than the moving average, and it comes in a little bit later than the exit. So you don't get all the little crossovers in between each one. And that's what it's doing. So it's just a nice little moving average system without all the crossovers, unnecessary crossovers of a standard moving average. So that's what that one is. It's kind of a fun one. And then we have volume by price. Now this is common numbers calculator. David Duty, one of the instructors that works, one of my buddies, he teaches a class. I've been trying to get him to come and talk on my class here, but he's always trading at the time teaching his classes. He teaches live classes. His name's David Duty. You can go find him on the web. Just search davidduty.com or David Duty common numbers or whatever. And he teaches trading, and he has a live. You can go join him. It's a couple $100 a month to sit in his class with him, and they sit and just watch the markets together and trade. So you can go join that. It's a live trading classroom. So anyway, he talks about something called common numbers, and that's what really volume by price is. It kind of goes hand in hand with David Duty's common numbers. So what he does is he has an idea, and it's basically all you're doing is you're coming in. Let's turn some of these things off. Oh, what happened? Went to a different chart. Let's go to a different chart. Let's go back to Apple. Oh, wait a second. What did I just do? I don't know what I just did. I don't like what that's an ugly view. I don't know what I just did. Let's go to AMD. I don't know what I just did to that. Delete all Apple charts. Options, yeah. Now let's bring it back, see if that, I don't know what I just did. That's better. Okay, back to Apple. We'll just use Apple. Okay, so we're going to get rid of our moving averages. We're going to get rid of our bulls and bears. We're going to turn on our MACD. And we're going to turn off our CMF. And we're going to turn on our momentum. We got it kind of hidden quietly in the background. Move it to the top. Move those over. There we go. All right, so we're back in business. We don't want these. I don't like these arrows from the MACD. Turn those off. Not display. They're telling you when to get out of the market. That's what these are not buy signals. The markets are, these are expansion, right? Telling you get out of the market, get out of the market, get out of the market, get out of the market. And then it comes down, get in the market, get out of the market. I don't like the arrows. I don't use the arrows. I like to use my own arrows using the overlays, like accumulate, or I like to use for arrows. Where are they? Chart overlay, ATR. Oh, come on, MACD. Didn't I turn your arrows off? Not displayed. I don't want those. Momentum, not displayed. Okay, MACD. So we're going to right click, save, and apply settings to all charts. All right, so this is our basic structure. So now we're going to come in. Which one are we looking at next? Oh, we got to look at the common numbers. So common numbers, what are common numbers? Common numbers just means that the market has had a tendency to come to that level a lot. So we draw horizontal lines across areas of support and resistance. And you're going to find that you get markets have a tendency to come to these levels over and over and over again. So those are your common numbers, right? Areas of support and resistance. Now, if you turn on your chart overlay and you got your volume by price, it's going to give you those common numbers in volume. So now it's saying, hey, the market has been at this location a lot. And so you can see the volume down, volume up, length of the bars. You can make the bars not so long, kind of scoot them off over here to the left. But you can see your common numbers based on volume. So now we're going to get rid of all the drawing tools. And you can see that this is an area where the market spent a lot of time right there. Spent a lot of time right there. Spent a lot of time right there. It spent a lot of time down in here. So these are less so. You got some in here. So now those are your common numbers, because that's where markets spend a lot of time. That's where a lot of volume was spent. A lot of orders were spent. You use those common numbers now as areas of support and resistance. It's kind of cool, right? So you can just, rather than just eyeballing it and saying, well, turn off your volume, and just coming in here and saying, well, all my areas of support and resistance are where these high peaks were. Here's one. It looks like one's here. Oh, I don't know. These are turning points, right? You just come in and you draw them out like that. Well, you're not sure. You're just saying, well, those are areas of support and resistance. So you're less accurate. You don't have as much accuracy doing it that way. And you come in and turn on your overlay, volume by price. Now you can see which ones were actually had more volume. Like this one up here at the very peak had almost no volume at all. So that's not really a good one. Market didn't really spend a lot of time up there. It is an area of resistance, and the market will look at that next time it goes up there, but it didn't spend a lot of time there. So we can, again, just get rid of those. Bring this down, and now you can see where your most important areas are. Boom, that's an important area. Spend a lot of time there on that price. Spends a lot of time. It spent a lot of time down here. We know that because it spent a lot of time back here. All right, there we go. And we're going back, price bars back. We're going back 275 bars. If we want to just go back, let's say we just want to go back from where the market's currently trading back to the bottom of the trend, we could do that and say, okay, that's 262 bars. Volume by price, 262 bars. We'll go 262. Now you're going to get a little bit of a different view. Not much, because we didn't change it that much. But let's start it back here. Instead of clear back there, let's just go to the bottom of the Elliott Wave trend. So we'll go right here, there, and let's go back. So 200. Let's just go to 200. So we go back to the settings on volume by price. We're going to change this. We go to 200. And now you can see where the higher areas were, just on the Elliott wave. Right there is a really important area. Right here was a really important price. Right here's a really important price. Not as important. Here's an important price. So you can see a little bit more important prices in here where the market spent a lot of time buying and selling. Kind of makes sense, right? That's what it is. That's what it does. Is it going to help you? Maybe a little. All right. The next one is the volume weighted average price. This one we call the rubber band. Now this only works. This is created by Zach Hurwitz. Volume weighted average price, VWAP, is a ratio of the cumulative share price to a cumulative volume traded over a given time period used for timing of entry and exit. Day trading tool only. Works only in intraday charts. It doesn't work on long-term charts. So we have to go down to a day chart, and I'll show you this one. And this will be the last one that we'll look at. And so we're going to come down here. We're going to go into, let's go to Apple. Let's go down to a 1-minute chart. Actually, let's go to a 2-minute chart. So this is our Apple 2-minute chart. Maybe we'll go back to a 1-minute chart just so you can see a little better. There's, see that little blue light? Let's come in here, VWAP, and I'm going to make it nice and bright for you. Well, it is kind of, let's go. Did that help? That didn't help. Let's make it a solid line, and let's make it a color you can see, magenta. All right, so there's your volume weighted average price. So what it's doing is just an average price of the bars. Let's go ahead and make them Heikkadashi. And it's just the average price of the bars, and it takes volume into consideration. So volume is down here. So there's volume. And it takes volume into consideration. So it's moving average, and it think of it as a rubber band. The market likes to come back to it. It swings back and forth across it. So think of again as kind of a delta cone of probability, and it's the center of the delta cone of probability based on volume. So it's just a different way of calculating the delta cone. So we're going to come up here. We're going to say that this is the delta cone at any given point. That's going to be the center of our delta cone of probability right here. And so if the market has a tendency to want to stay within the delta cone of probability 80% of the time, 65% of the time, then we're going to see that market is just going to always hover around that moving average. And so if it gets too far away from the moving average, it's going to come back to the moving average. If it gets too far away from the moving average, it's going to come back to the moving average. It gets too far away from the moving average, it's going to come back to the moving average. Too far away from the moving average, it's going to come back to the moving average. Go down, it's going to come back. Just think of it as a rubber band, and it's going to pull the market back to the moving average. That's because it's the delta cone of probability. Once again, it's just another way of measuring how far away the market gets from a mathematically calculated center line. That's what it is. And the further away it gets, it goes up here. And the further away it gets, the further away it gets, the stronger the pull is going to be to return back to mama. And that's mama. So that's the VWAP, volume weighted average price. All right, guys. I think we've got about everything covered that we were wanting to cover. Oscillating indicators are the single most misunderstood tool in trading. Everyone's looking for the Holy Grail. Sorry to disappoint you, but it does not exist. If you find it, please let me know. I've been looking for 40 years. That's me. Famous quote. If you find it, please let me know, because I've been looking for it for 40 years, and I never found the Holy Grail. There is no Holy Grail. You have to use a combination of tools, always a combination of tools to help you make your trading decisions. And it's always not just a whole bunch more oscillating indicators, just 10 of these. That's not going to help you do anything, because as you've seen, most of them do almost exactly the same thing. There's a few weird ones down here that do some stuff that are different, but for the most part, everything's just doing some sort of moving average down there. So you have to do it with you have to coordinate it with your trend lines, your reoccurring price patterns, your Elliott wave, your accumulation distribution models, Fibonacci retracements and projections, your delta cone of probability, and then just tie it all together with your indicators and let your indicators confirm what you're seeing up on top in price. And then that's where you make your trading decisions. It's supposed to make things easier, not harder. I know there's a lot of them. You don't have to use them all. That's the point. You don't have to use them all. Just use the one that you like. Just use them. Just start off with the MACD. Just use the MACD. If you don't want them to put the momentum behind it like I do, you can do that. But even there, you don't have to. Don't get. Keep it simple. Keep it simple. We come in here, delete all the tools. Use your Fibonacci bars. I really think those are good for everybody. Fibonacci bars, ATR, MACD. Just start there. Just start there. Get rid of all this stuff. All right, even get rid of volume. We're going to talk about volume in greater detail because we got to talk about volume, but volume's important. But just start right there. This would be a day trading, right? Kind of a day trading tool, but we don't have VWAP on a daily chart. But on the daily chart, you're going to do the same thing. You're just going to look for accumulation distribution. You're going to look for points where you can be buying as markets go into accumulation in anticipation of a rally, and then you can see right here, right here. There you go. That's what you're going to anticipate. Just do that. And if you're wrong, get out. Or if you're going to do it on a daily chart, you're going to do some investments. We're going to teach you next week. Or in 2 weeks, we're going to teach you how to do options to protect yourself to the downside in case you're wrong. And we'll teach you how to put a little insurance on your position so that you don't get your hiney handed to you if you do it wrong. If you get in and the market doesn't go in your favor, you can have some insurance that's going to protect you rather than just getting out and saying, oh, well, I just got out because I was wrong. We could put some, what I call a soft stop on you don't get out of the market. You just stop losing money. So we'll put a soft stop on. We learned that with options. That's an options strategy. Okay, guys, that's all I got for you. And past performance is not necessarily indicative of future results. Make sure you use those indicators as the intended purpose, which is to confirm what you're doing on your other trades. If you guys have any questions, let me know. And this is the software I'm using just in case you weren't aware.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
And that's it. That's all I got for you today. And we'll catch up with you. Let's see, tomorrow is Friday. So tomorrow evening at the university, there will be no online class tomorrow, and we'll start up our online classes again next week, which will be a week off. So we take that week off, but we'll still have labs. So we'll go probably Tuesday, Wednesday, and Thursday for the labs next week. And then we'll start class up again, and we'll do options, and we'll have options labs, and we'll follow up with options labs after that. And then that'll be the end of the semester. We'll be done until my next time that I teach at the university will not be until fall. And so October will be the next time you'll see me at the university. But I will keep teaching online through the whole summer. We'll just keep having our classes online, just keep doing it. Follow along with me online and subscribe to the channel so you get notified when we do our labs. And give me a thumbs up if you guys learned anything today. If you thought the indicators was a fun class, hit that little thumbs up thing. I always like to see that you guys were paying attention. And we will catch you guys next time. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.